What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. Welcome to Raise the Bar, elevated conversations around entrepreneurship, capital raising, and real estate. Today's guest, Jennings Smith Jr., is the CEO of My First Million in Multifamily, co-creator of The Deal Room, and the host of Unlock Your Life podcast. From 2 rental homes to a $60 million real estate portfolio, he's helping thousands of investors achieve financial freedom and unlock their life. Jennings, welcome to the show, brother.
What's up, Seth? Appreciate you having me on, man. Good to be here.
Absolutely, brother. Man, I've been watching from afar. We've had a couple of conversations and cross paths on social media, but I'm excited to dive into a deeper conversation with you, man.
Yeah, absolutely.
Well, look, man, for a lot of entrepreneurs, it tends to be a complex question. So, but I'll ask you, when people come up to you on the street and they say, "What do you do?" What do you tell them?
I try to distill it down into a simple thing, and I try to say something that's in it for them, right? That's going to pique their interest. Instead of just saying, "Well, why do real estate and blah blah blah," it's like, well, how does that help them? So I've really thought about, okay, what's in it for them? I say, hey, you know how these big real estate deals like apartment complexes, self-storage facilities, development projects, those are out of reach for most people, and there's a lot of technical know-how to own and operate those things. So what I do is I group investors together, we take down these deals, and we share the profits. And I shut up, and sometimes it leads to, oh, what kind of deals do you do? And there's further interest, and sometimes it doesn't. But if there's further interest, they're already starting to think like, I wonder how I could get in a deal like that. Like, that sounds interesting. So
nice. Yeah, it is an interesting thing to see like what the response is when you say, I'm a real estate investor, or you be a little bit more vague than the answer that you gave, because then people just kind of assume that you're a real estate agent, or maybe you fix and flip houses, that sort of thing.
Yeah.
So kind of diving into the commercial real estate side, people are a little bit sometimes clueless because they're just not in it, right?
Yeah, it's like if they're asking you, it's how can I make money in real estate? That's what I do. I help people make money in real estate. We do hard money lending. We do joint ventures and raise capital. We teach people how to raise capital, how to find deals, how to operate them. We have a community tribe where it's like, hey, I need a loan sponsor. I need somebody to help me raise money. I need a local partner here and there. Putting the people that are already doing what you want to do in the room to help you get it done. And so it's like I try to frame it for how can it benefit them. Totally.
Well, speaking of that, what are you seeing out there as far as raising capital and what's working and what's not? We're kind of past the heyday where it was fairly easy to raise a lot of money, kind of from up to the beginning of maybe 2023 or the end of 2022, when the interest rate spiked up, deals got a little bit tighter, and now it's a little bit harder to get investor capital in. What are you doing that's working for raising capital?
So it definitely has gotten harder. I don't want to make it up and be all flowery and rosy. I think the last 2 to 3 years have been some of the hardest in real estate that I've seen in my whole lifetime. I'm 42 years old. And it's a difficult conversation different environment, but there's still money there, right? There's still people that have capital. There's still people that want to be partnered with the right operators and in the right deals. It's just getting more concentrated, right? And it's almost a good thing for people that are moral, doing the right things, trying to everybody makes mistakes, but trying to protect investor capital and get them in the best risk-adjusted deals they can. And so I think for the people that are still here, right, and they still have viable deals, they haven't had foreclosures and things going, totally south, it's not as difficult to get that. But on the same time, it's got to be a really, really, really good deal. And that where before, you could pass off like, oh, we're going to get 15% IRR if we give away 90% of the deal. Like that's a super skinny deal. If they've got to give away 90% of the deal to just make them a 15% return, if anything goes wrong in that deal, like that pro forma is shot. And so there's got to be deals with a lot more meat on the bone. But I have seen a lot of success with the gems. They still are filling up, right? The mediocre deals, they're not. They're struggling. People aren't as easily influenced to get into those like average deals. So I think it's being more selective on who you're going to partner with, who you're going to place your investor capital with, and is there margin in there for things to go wrong?
Yeah, for sure. Yeah, I think a lot of the deals that you've seen lately that haven't went well, there were a lot of really aggressive assumptions underwritten into those deals, and they were still coming out rather skinny towards the end of this run, right? Like aggressive rent projections, aggressive expense allocations, things like that. And it was still pretty skinny. You still had to see like an 85-15 or 90-10 split to get any money out of it, which is pretty insane. And then when those assumptions didn't come true, some of those deals did not turn out very well. And nowadays, it's got to, like you said, it's got to be a great deal because you're not able to justify some of those crazy assumptions that you were maybe in 2020 to 2022 when you're like, oh, well, look, the last 5 years in Austin, the rent has went up 8% every year. So let's just keep underwriting that. Obviously really aggressive, but at least you could maybe say, well, look, this is what has been happening. So we're going to say it's going to continue to happen. Can't do that nowadays. So it's really hard to make those deals work. So they've got to be really good deals.
It is, and there's recency bias with an underwriter or with a deal operator where you've seen, hey, rates have been at 3.5% to 5% for the last 10 years. It's probably likely that in 5 years when I refinance, my rates will be around 4.5%, and in actuality, they were at 7 to 8%, and that's a huge swing on a deal. It's the cap rate in this market has been this way, and now we're seeing expansion in cap rates. Cap rates are very sensitive in the underwriting, how they're going to affect your refinance valuations, your sale valuations. We've seen insurance go through the roof. We've seen, obviously taxes are always going to go up, but labor on repairs and maintenance, it's been a bloodbath out there in multifamily. I'm not going to lie.
Yeah. How have you pivoted your business, or what kind of adjustments have you made to make this work and to survive through this kind of down period that we're in right now? Because I've seen tons of people that were in this space, let's say 5 years ago, that are not in it now, right? Like they've had to go back and get their W-2. Their company, their real estate company has went under. I mean, what have you done to kind of stay in the game and do it well?
So that's a great question, and I want to. The people that are still in this game, kudos to you, right? If you're still here and you're still putting in the work and making the things happen, like that is not everybody. That's not the case for everybody. So shout out to you. Keep going. I definitely think there are good times ahead. We're seeing a glimmer of that. And I think 26 and 27 are going to be even better. But what I did, a couple things. One, I scaled from the end of 2018 to 2021, I scaled up to like 1,300 multifamily units and another 500 self-storage units. And that was too much, too fast, right? Deals started breaking. I had way too much on my plate. My property managers, some of them were slipping. And at that point, I got scared, and that was good, right? I was very nervous, and I'm like, this is way too much. And I turned off the acquisitions machine. I still would do deals with other partners that I trusted, maybe raise a little capital for them and be involved. But I'm like, how can I go to 2, 3, 4, 5,000 units with the systems and processes and teams that I have in place now? This is going to get worse. You can't scale chaos. And so that was a key difference, because there was a whole nother group of thought that was like, let me outscale my problems. Revenue is the answer to everything. And they kept going to 3 and 4 and 5 and 8, 10,000 units over the course of 5 years. And you gotta, like, I had to be honest with myself. It's like, dude, yeah, you've been buying rental houses and you were a contractor, but you are not qualified yet to be running and managing a 4 or 5 or 10,000 door portfolio. And so don't do that. And so that was one thing that saved my butt is I stopped buying aggressively in 21. And the guys that did continue on, a lot of them are in, I mean, look, kudos to them. They got bigger balls than I do, but a lot of it, it's like, hey, half their deals are on fire, getting foreclosed on, losing investor capital. And so what's the point of that? You know, I'd rather not have that or live through that. I don't have the risk tolerance for it. I don't have the stomach for it. And so the second thing I did was I pivoted quickly where I had, I mean, 2 examples. I had 2 loans that were on floating rate bridge debt, very aggressive debt. I mean, they rolled in like my first 10, 12 months of payments into the loan. I didn't have to bring a whole lot down. And I'm like, hey, I've already done this a couple times, you know, stabilizing properties in 1 to 2 years. And 1 to 2 years in multifamily is a blink of an eye. And if anything starts to go wrong, like you need more time. And when you're on bridge debt, yeah, they can give you extensions, et cetera, but you have a gun to your head. And then when you're on floating rate, obviously we saw how that panned out. And so right in the beginning, when they're starting to raise rates, I'm like, this is not good. I'm freaking out. And I've got these 2 projects that are like, one's halfway through rehab, the other one's maybe 3/4 of the way through. And I'm looking at my projections, and I'm just thinking, I'm not going to make this turn. There's no way I'm going to get these stabilized, set up, and sold or refinanced within my bridge debt time. And every time the Fed raises rates, they're chopping hundreds of thousands of dollars off the value of these buildings and what my future buyers can pay. And so I talked to Yaden, my partner. I'm like, dude, we got to move. We got to pivot right now. We got to sell these 2 properties because they're the most dangerous things on our portfolio. And we did that. And so one was I think it was like a 90 unit in Statesboro, Georgia. We immediately put it on the market and it sold. It sold quickly because, you know, sentiment was still good. Like they'd only raised rates like once or twice. And I don't know why I had this huge feeling of dread, but I did. And so we sold, we turned an $800K profit on that, and we had only renovated halfway. It was still, there was like euphoria in the market still left over. The next one was in Clemson, South Carolina. It was like an 84 unit. And that one took longer, and the rates kept going up, and we got it under contract, and we ended up selling that at essentially break even. I think we made like 50 grand, but we got all the investors their money back. It was only tied up for less than a year. And we just got those off our plate. We didn't try to get cute with it. Like, oh, well, we can refinance and we can hold these forever and da-da-da. And then I started looking at my portfolio, like, what are deals I don't want to hold? Like, what are, like, some deals are working great. We've cashed out the investors. Like, sure, let's hold them. But let's shed stuff that is risk to our portfolio. And we looked at our property out in Oklahoma, 208 unit, all in for $8 million. And we're looking at, we'd already cashed out, refinanced the investors. Like it was quote unquote solid, but we didn't own anything else in Oklahoma. You know, the roofs were going to continue to deteriorate, the balconies, maintenance, repairs, on and on and on. And it was a pretty big deal. And so we said, hey, we've got a great assumable loan at 4 1/8. Let's put it on the market, see what happens. And it went under contract at $12.6 million. And we were able to take chips off the table there. It was a big win. And it was a kind of backwards to like, hey, refinance, burr, and just hold forever. It's like, look, we have $4 million of profit here, and there's a lot of risk on the table of what could happen in the future if rates keep going up, if, you know, taxes go up, insurance, et cetera, et cetera. I mean, tornado could rip through this thing. There's all sorts of things that are you're risking your money by leaving it in the deal. And so I liquidated 500 or 600 units, and I think that was also a good move. And then I pivoted to easier assets to manage, right? That's a big time suck and easier assets to manage. And I bought a couple of triple net lease deals, commercial deals. And now I'm working on a development deal, doing flex warehouse space. We also utilize a lot of that cash to buy out our partners in existing deals. So now we own them 100% with no investors and less partners. And so it's like the deals that are working, let's buy the people out, invest our cash there instead of taking on more risk and buying another deal. And we still did one-off multifamily deals with other people in the deal room. And I'm still open to multifamily. I just have to get something that I know is going to work because I know too much now. I know how hard this stuff is and how much it costs to do.
Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more. Totally, man. Yeah, I mean, what I'm hearing there is like you have really good intuition. Your instincts told you, hey, like something's kind of brewing here in the market, and I don't want to wait around to figure out what it's going to be. And let's start kind of looking overall at our portfolio and seeing like what are these assets that might get us into trouble, and you're able to get out on top before shit really hit the fan. And also willingness to change. You have the willingness to pivot, to change, to look at other asset types, things that might be easier to manage, things that might be a little bit meatier. And yeah, I mean, it seems like things turned out pretty well.
I mean, the goal of this is to make money, right? To make money in the lowest risk way that you can. It's not to go to the conference and stand on the stage and beat your chest and say, I have 8,000 units. Like, that's not my goal. My goal is financial security for my family, consistent, durable, passive income rolling in every month that I can count on, that my investors can count on. And so I'm going to do that in different ways. I'm not going to just marry myself to like, well, I have to hold 3,000 units for 20 years. But the ones that are working, like I am going to hold them for 20 years. I'm going to pay them off, and we're well on our way, and we have a lot of equity in them, and they're cash flowing well, and we made it. We made the turn. We made it through the woods. Hey, hang on, keep on doing it. But you got to be willing to pivot. Like I've got a unit right now, had a great property manager, and he just sold his company. And we're in talks internally now. Okay, are we going to take that under our management arm because now I've got risk again? Like I don't know how this other company that bought him out is going to perform. And do I need to sell it or do I need to take the management in-house? But we've got something here that we need to pay attention to.
Yeah. Let's pivot a little bit. I want to ask you about marketing, just generally social media, things like that, because that's where I first heard about you. Like your Facebook group just blew up. I mean, it was insane. I felt like everywhere I looked, I saw your name, I saw your Facebook group, I saw my first million in multifamily everywhere. I guess what kind of triggered you to start that, and how did you grow it so quickly? Like what was it about that really grew so quickly?
I think part of it is cycles, right? Product market fit of what the market wants at the time. I'd like to say I'm a genius and I'm so charming and it was all like, and it was a lot of work. I'm not going to lie. It was a lot of work. But part of it was, multifamily was heating up and it was a attractive asset to get into. And so that helped fuel some of the growth, was just the timing of it, which was blind luck. But on the, what I actually did was I gave a lot. I would break down like, hey, this is what I paid for this. I would break down numbers. Like I'm a numbers guy. Like I like to know the details of, anybody can BS you, like even saying, okay, he has $60 million in real estate. Well, what does that mean? How much of that is debt? How much of that is investor equity? How much of that is partners? How much does he actually own? And so I tried to be transparent with my journey and what I'm doing, like sharing numbers instead of just this like vague, over glorified. I wanted to tell people, this is how many units we're buying. This is the price per unit. This was the NOI. This is why we think it's a good deal. And just sharing that. And people would reach out to me like, how are you doing this stuff? Can you teach me? And I would jump on the phone with people. Yaden and I would do a weekly show, just sort of documenting our process, and being very engaged with comments and all the stuff that people know how to do and should do. But I think it was my, like, just being genuine with people and trying to be transparent, like telling them about the losses and the good and the bad. And it was crazy because as I'm talking to all these people, I'm like, I'm really not helping them by having a 30-40 minute phone call. Like, they can't copy my process. They really can't close deals or build relationships. And that's what got us to build out the deal room, which was, document our process in a course and then build a community of people that could actually sponsor loans and raise capital for them and help them. And when we launched that, I mean, the response was huge, because I think we had given so much for so long that people wanted to be a part of what we were doing and support that. And so, yeah, but it was just day in, day out, doing the shows, posting, documenting the journey, because so many people, they don't talk about what they're doing. Everybody has content, and it's just talk about, hey, I made an offer on this and it got rejected, or I talked to an investor and he said yes, or he said no, and what I did right, what I did wrong. But the Facebook group really was the kernel that founded the deal room. But I started the Facebook group just to get investors to invest with me, to get other people to refer deals to me or partner with me. So I had a good, genuine purpose of the group of just to get exposure and tell people what I'm doing and get more people to know me. And it's who knows you and what you're doing. That way they can help you. They can be involved with you. Facebook stories. And I mean, 70% of the money that we raised for our deals came from Facebook and Instagram and people that we really didn't have a one-on-one personal relationship with. We were able to build that trust just through that. And that's why I do a podcast. It's like somebody can sit there and talk to me for 30 minutes, get to know me and my heart. And then when they call me and they talk to me, they're like, hey, I want to do the deal room, or hey, I want to invest with you, or I want to partner with you. So it's super powerful.
Yeah, man. I mean, from what I remember, because it's been a little while, but I remember just being sucked into it because you were super, and I think these words get overused, but you really were. You were super genuine and authentic. Like, you just felt like a real person. You know what I mean? Like, a lot of people with the big names and stuff, they're out there and they're putting out content, and some of the content is overproduced, and they're not really talking about the details and the nitty gritty, and here's my exact deal, and here's the numbers behind it, and here's why I like it, here's why I don't. It's more like, hey, join my $20,000 a year mastermind, and then I'll tell you some more about this and that, or it's always behind like a pay gate, right? And you were just kind of giving everything away and just providing value, and I think people were really attracted to that.
Yeah, I do have a heart to help, and that's one of my favorite things about the deal room. Is hearing the stories of them winning and succeeding. Now, I will say on the flip side, like I think the pay gate barrier, it is helpful because there's a lot of people out there that they want to talk to you and waste your time just to make themselves feel better of like, oh yeah, I might be doing that one day, but they're not really willing to, like, I'm going to put 10, 15 hours a week into this. I'm going to call investors. I'm going to call brokers. I'm going to put my money where my mouth is. And so I wanted to have like a little barrier of entry, but not $50,000 or whatever, like these guys are charging. Like, it's got to cost something so that they're committed. And I also only take on people that already are in real estate or have real estate. Like, I don't want to deal with the guy that works at McDonald's that thinks he's going to go out and buy a 50-unit apartment. I mean, maybe he can, but I just, it's like the chances are very little.
Yeah, and I totally agree with that. I mean, not just for yourself having to make some money with you putting all that time in, but also the commitment by the person. Like, if they're not putting money in, sometimes they're just not going to extract the value out that they need. When they put the money in, they feel like, I better actually act on what I'm learning here, and I better try to make my money back by investing in real estate, by trying to buy an apartment building, by doing these things. And if they don't invest that money, there's just not the incentive to perpetuate action. Yeah,
I wish it wasn't that way, but that's it's like you pay attention to what costs you something, right? If something doesn't cost you anything, whether that's time or money or effort, you don't care about it.
Completely. Completely. All right, man, I like to ask everybody about this. In a different parallel universe, what's a different version of you if you weren't doing what you do now and what you've done? And I'll give you an example. For me, I was in med school for about a year and a half and absolutely hated it. And I dropped out and I went a different pathway. I became an attorney and got into entrepreneurship and real estate investing. Totally different life if I had became a doctor, right? Like not better, not worse, but different. Like what's that for you?
So when I was in high school, I went to my dad and I said, Dad, I want to be a lawyer, because I thought, well, lawyers make a lot of money. I want to be a lawyer. And so he in his wisdom, he said, okay, I'm going to buy you this. It was like some like online law class or something. It was like an intro to law. He's like, I want you to go through this and see how you like it. And I'm sitting through these classes like tort law and contract law and this, and I was like bored out of my mind. I hated it. And within a few weeks, I'm like, okay, I don't want to be a lawyer. And so I do think about that some. But I have always been I've always thought like an alternate version of me might have gone to, New York City and become like some sort of investment stock guy, analyst. But at the same time, I don't know that would have been the right fit for me, getting burned out working 80 hours a week in New York City. So I'm grateful for the life I have. But those are definitely two things that I looked at pretty heavily.
Yeah, that's awesome, man. What's one limiting belief you've had, and how did you kind of overcome that?
I would say growing up, my dad, from what I knew, he always made, he eventually made six figures in real estate. And it was kind of like, this is the goal, right? You want to make six figures so that you can take care of your family and have a good life. And that's fine. But on the other side of that, there was almost this, and it might have been my own, it might have been my parents' influence, but it was almost like, you don't want to make too much money though, because if you make too much money, then you're going to screw up. You're going to get divorced. You're going to mess up like your life and like, look at this rich guy who wrecked his life. And look at that rich guy who, left his wife and this and that. And so that was kind of like something that was never said to me, but it sort of seeped into my brain. And now my internet's not connected. Seeped into my brain. And so that was something I had to work on, was like $100,000. I shouldn't have to work 365 days a year to make that. There are other opportunities. There are ways that you can implement ideas and create $100,000 out of thin air. And so that's what I would say would be my limiting belief.
Yeah. I had something similar, not exactly spot on there, but I grew up without entrepreneurship and real estate around me. So my parents were a retired coal miner, retired school teacher. So, it was like, what's the best job you can get? And it was always like, go become a doctor in my mind. And then it became go become a lawyer after the doctor thing didn't work out. Yeah, and eventually I finally broke out and said, look, I'm an entrepreneur. And that's kind of like what has really driven me all along. What's one limiting belief you've had, and how did you overcome that?
So growing up, your dad is your model of what's acceptable. And, in his real estate, he was a realtor, and he eventually got, making about six figures a year. And it was sort of laid out as that's the standard, that's the floor, which was good. But there was this sort of other side of the coin of you don't want to make too much more than $100,000 a year, because you're going to be susceptible to wrecking your life. Like you leaving your wife, you're too focused on money, you're not taking care of your kids. And there is for sure a balance there. But as I got success and was able to, make $100,000, I think I kind of got stuck there for a couple of years, and real estate really helped me break through that, and understanding, man, I don't have to trade 40 hours a week, 52 weeks a year to just make $100,000. I can take ideas, I can implement them, and I can create value for other people and create, $500,000 a year, $1 million a year. I can build a big portfolio of real estate that will pay itself off. But it really did hold me back because I'm thinking I deserve about $100,000. If I'm making $100,000, that's a good stable place. I don't want to go too far beyond that, or you're going to get in trouble. You're going to wreck your life. And so it was something I had to really dig into, audit those thoughts of why do I think that? Is that right? Is that true? Is that going to happen to me? No, none of that's true. And it helped me break through some of those barriers to, hey, you can raise capital, you can close this deal, and you can sell it for a multi-million-dollar profit, and your investors can make money too, as long as you're willing to take those risks and put yourself out there. But you do have to get beyond that comfort zone and beyond that belief to do that. Everybody wants the result, but it's you got to go on that journey to get that result.
Yeah, that's really interesting, man. Just that belief, that if you make too much money, it's going to turn you into a bad person. I mean, totally not true at all. I think you're doing fine, dude.
Well, money is an amplifier, right? It's just an amplifier. So yeah. If you have some issues, money's going to amplify that. But if you have good qualities, philanthropy, helping other people, creating opportunities, creating jobs, etc., it's going to amplify that too. And so, I think you got to work on yourself and what is that money and success going to amplify, and hopefully it's a good thing.
100%, brother. Jennings, it's been great having you on the show. Where can our listeners find out more about you?
So Jennings Smith Jr., like Jennings Smith Jr., that's my website. It's got all my podcasts, got the deal room there, the Facebook group. You can connect with me, or you can hit me up on Instagram. Jennings Foster is my handle on Instagram. And I got my DMs. I don't have a VA or anything. So if you hit me up, I'll text you back.
All right, brother. Great having you on. Appreciate it.
All right. Thanks, Seth. Appreciate it, man.
Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.